Okay, you guys, we're now going to take a look at exercise 4.1 on page 208. And here, the point of this exercise is to get you to determine or tell the difference between items that should be included as a part of operating income, and then some items are not included in operating income. They would be considered non-operating income. So let's flip back in your chapter and look on page 174, operating versus non-operating income. Second sentence there, it says operating income includes revenues and expenses directly related to the primary revenue generating activities of the business. So for instance, if we're dealing with a hardware store, selling hardware and goods would be their primary revenue generating activity. The cost of the inventory, their utilities, the rent on the building, those would be operating expenses for them. Non-operating income would be and expenses would be things like interest revenue, interest expense, gains or losses, and just activities that are not a part of the normal operations of the business. Okay, so let's read the exercise 4-1. It says Pandora Corporation operates several factories in the Midwest that manufacture consumer electronics. The December 31, 2016 year-end trial balance contained the following income statement items. Okay, we have sales revenue, interest revenue, loss on sale of investments, cost of goods sold, selling expenses, general and administrative expenses, interest expense, research and development expense, and income tax expense. Okay, so we'll start with sales revenue. Okay, this company manufactures consumer electronics, so selling those electronics would be a primary revenue generating activity for them. So sales revenue would be listed first. That would be a part of operating income. Then from sales revenue, let's go down the list. Interest revenue would not be considered part of their normal operating activities. Now, it would be for a financial institution. They're in the business of earning interest, but a manufacturer of consumer electronics is not. So interest revenue would not be picked up. A loss on sale of investments is not a part of operating income. Selling investments is not related to selling consumer electronics. Cost of goods sold would be a part of operating income. That's the cost of the inventory that we sold that year. So would selling expenses and general and administrative expenses. Those are, of course, part of operating income. Interest expense is not. It would be shown separately. Also, income tax expense is shown below income from continuing operations. But research and development expense would be a part of that operating income. So, we're going to deduct our operating expenses. We've got cost of goods sold, selling expenses, general and administrative expenses, and research and development expenses. Now, when we total those, we get $9,540,000, which we'll deduct from sales revenue of $12,500,000, and that gives us operating income of $2,960,000. Now, those other items, you guys, would be shown on the income statement below operating income. They go on to tell us here. Please note, interest revenue, loss on the sale of investments, and interest expense are all non-operating items and would be reported on the income statement as other income or other expense. I believe, if you remember, we talked about that some in chapter 5 in financial accounting. Those are called below, and they would be reported on the income statement below operating income. because they're not a part of normal operations. Income tax expense is a separate line item in the income statement after the non-operating income items. Okay, you guys, after watching this one and working it along with me, and I would probably do that on paper if I were you guys, you should be ready for exercise 4.1 on the Course Connect website. If you have any questions, please feel free to contact me anytime via email or on my cell phone at 828-593-0459. Thanks.